Chapter 13 is on analysis of the financial statements. And we're not going to go into a lot of detail in this. We've done some ratio analysis already. Chapter 13, very simple topics here: vertical analysis and horizontal analysis. And I believe I can handle it in just one voiceover of the PowerPoints. Vertical and horizontal analysis. Horizontal is really trend analysis. And if you think about horizontal, you're talking about going left to right. And so in your mind, you can probably visualize financial statements for consecutive time periods being placed side by side. When you do a horizontal analysis, then you're going to be comparing the numbers on a line-by-line basis. So it could be that you're going to look at gross profit from one period of time to the next period of time. Again, think of it as a financial statement, and think of it as financial statement showing the numbers for 2 consecutive years. All you're doing is trying to calculate the percentage change from one time period to the other. And you always start with the earliest time period. So in this case it would be 2013, and you go on to 2014 to calculate the percentage. Vertical analysis, on the other hand, is going to go up and down a financial statement. So think of vertical as being up and down. So you're going up and down the financial statement with vertical analysis. And with vertical analysis, you are looking and comparing all the line items to one particular number on the financial statement. For the income statement, it's going to be revenue. In this case, it's showing as sales. And for the balance sheet, it's usually total assets. We'll have examples of these in a moment. Then we also have ratios, and you've already done ratios in previous chapters, so I don't believe it's really important for me to go back through all these ratios again with you, but you've already seen them. So trend analysis is usually calculated in terms of year-to-year dollar or percentage changes. So this is the formula, an algebraic type formula. I would prefer to just look at numbers in the example. I think that's easiest. But notice that what we're doing when we're calculating the rate of change, we're using the earliest year on the bottom, and we're calculating it based on the current year minus the earliest year on the top. So the denominator should be the earliest year. So in this case, we're doing horizontal. You have a financial statement for 2 consecutive years. Horizontal is across. So our analysis is going to be the current year minus the previous year divided by the current year gives us a percentage change. Now if we use the current year first and we subtract then this from this, it'll come out right. It'll be a positive change, and it'll be a 5.7%. So we say there's a 5.7% increase in revenue. And what you're going to do with this sort of analysis is that you can go through it and you can say, well, revenue increased 5.7%, but net income for our company increased by how much? 16.7%. Okay, so that's the sort of analysis you do. Again, it's line by line. You can't go down this column and add and subtract and make any sense of it. It's not going to work. Horizontal is just going across, going across, going across. And so you're repeating that over and over again. And the easiest way to do these things is to put them in Excel. I don't know if you know Excel or not, but putting it in Excel will be just so easy. It's so easy to calculate the amounts if you just put it in Excel, because you're going to copy a formula. The formula is going to be the latest year minus the previous year to get this, and then that amount is going to be divided by the earliest year to get this number. This number is a percent, So when you do the calculation, this would be 0.057. You will get that for your result, unless you go in and you format in Excel as a percentage. So here again is that calculation. Really isn't necessary for you to learn the algebraic formulas that were on the preceding slide. Vertical and the remainder of the trend analysis, you can continue with that and calculate the others. The vertical analysis, on the other hand, is going to take it as a percentage of some number. On the income statement, it's revenue. And I'm going to say revenue and not sales, because for a merchandising company, yes, you're going to have sales. But for a service company, it would be revenue, some type of service revenue. So you're not limited in doing this for a merchandising firm. You could do this for any company, any that has the financial statements. You're going to do the cost as a percentage of revenue. You're going to go gross profit as a percentage of revenue, operating expenses as a percentage of revenue. Now, unlike the horizontal one, you can actually go down these columns and you can say this minus this equal this. Okay? This minus these items gives us this. Now, you may have some rounding issues. That's to be expected. So it really depends on how far you want to take out your percentages to get rid of the rounding problems. So this is done, again, vertical, so think up and down, and if it's an income statement, it's going to be as a percentage of sales. If it's going to be a balance sheet, all the numbers are going to be as a percent of total assets.